Hey everybody, welcome back to the channel. If you are shopping for a home right now, or you've been watching mortgage rates and wondering why the hell won't they just come down the way you had hoped, this video is for you. Today, I'm going to be breaking down what is happening in the financial markets right now, and I'm going to connect the dots for you in plain English. No Wall Street jargon, no confusing charts, just straight talk about how all this affects your mortgage rate and your buying power. So grab a coffee, sit tight, and let's get into it. All right, guys. So let's start with the big picture. There are three major things happening in the market right now that are pulling on mortgage rates at the same time. And honestly, it's creating a pretty complicated situation. Those three things are oil prices, the stock market, and something called mortgage bonds. You've heard about this. So let me break each one down. Oil prices. First, oil. Right now, we all know it's sitting just above $100 per barrel, and it is stubbornly high, right? And I know what you're thinking. What the hell does oil have to do with my mortgage rate? And that's a great question. Here's the connection. When oil is expensive, everything gets more expensive. Gas, groceries, shipping costs, it all goes up. That's inflation. And when inflation is high, mortgage rates tend to rise along with it because lenders need to protect themselves from the fact that money they lend out today will be worth less by the time you pay it back. On top of that, the situation with oil isn't getting better anytime soon, it seems. There are real geopolitical tensions, including escalating rhetoric between the U.S. and Iran that could push oil prices even higher. So this is something that we've got to watch really closely. Next, mortgage bonds, okay? This is the most direct connection to your mortgage rate. Think of mortgage bonds like this. When investors feel safe and confident in the economy, they put their money into stocks. But when they're nervous or uncertain, they park their money in safer investments like bonds. And when more money flows into mortgage bonds, rates actually go down for home buyers. Right now, mortgage bonds are having a really tough time. They've been getting beaten up, mostly because of those high oil prices driving inflation fears. But today, they seem to be attempting a small recovery, which is a slightly positive sign. Whether it holds, it's the big question. We don't know. Okay, and now I want to talk about the Federal Reserve, the Fed. You all hear that, the Fed, because they are playing a major role in this whole story, and not necessarily in the way you might expect. Most people think the Fed controls mortgage rates directly. They don't. What they do control is short-term federal funds rate, but mortgage rates are more closely tied to the 10-year Treasury bond and mortgage-backed securities. They're related, but they're not the same thing. Here's what's actually going on behind the scenes. From December through April, the Fed was buying up about $40 billion per month in short-term Treasury bills from the banks. The reason? Banks were having some liquidity issues. Basically, they needed cash. So the Fed stepped in to help. But here's the problem with that, and this is very important. When the Fed pumps money into the banking system like that, banks lend that money out, which creates more money circulating in the economy, and more money circulating means more inflation. It's kind of like pouring gas on a fire that you're trying to actually put out. Now, compare that to what they did back during the pandemic. Back then, the Fed was buying 10-year Treasury bonds and mortgage-backed securities, which actually helped push long-term rates much lower. That was the right kind of buying back then for mortgage rates. What they've been doing recently, not so helpful for you, the home buyer. The good news, the Fed has started tapering down those purchases from about $40 billion to $20 billion a month, and they may cut it back even further. Plus, as you know, there's a new Fed chair on the horizon, Kevin Warsh, and he's been historically opposed to that kind of bond buying. So if he takes over and puts a stop to it, that could eventually be a positive sign for long-term rates. But And I don't want to be honest, with you. I want to be honest with you. We're not quite there yet, okay? So, lastly, I want to talk about the stock market because it's been on an absolute tear lately, as you can see, especially in that AI sector, tech sector. And look, I want to be careful here. We're not here to tell you that the sky is falling, but we are going to look at some numbers that should at least make you raise an eyebrow and think a little bit. Here's what's happening. The NASDAQ, which is the tech-heavy stock index, has risen about 80% since April 2024. That's roughly 13 months. And just in that last month and a half, it's up nearly 30%. Now, here's the thing that's worth comparing. Back in October of 99, right before the dot-com bubble burst, the NASDAQ rose 95% over a similar stretch. In the final month before the peak in March of 2000, it went up 37%. Are we saying we're about to have a crash? Absolutely not, but we are saying keep your eyes open. There's another stat that's really telling right now. NVIDIA alone makes up 80% of the entire S&P 500. That's bigger than the entire healthcare sector of the U.S. economy. One company, and they're reporting earnings this week, which could be a major market mover in either direction. So here's what makes this tricky. While the major indexes are hitting all-time highs, 9% of individual stocks are hitting lows. Same time, and more than half all stocks are trading below their 50-day moving averages. So this tells us the rally is very narrow. A small group of companies is dragging the whole index up while a lot of the rest of the market is quietly struggling. The Shiller price to earnings ratio, which is basically a measure of how expensive stocks are relative to earnings, is at the second highest level in history. The only time it was higher, the dot-com bubble. So what does this mean for mortgage rates? Here's the key connection. When the stock market eventually corrects, and it always does at some point, money flows out of stocks and into bonds. We saw this happen in 2000 at the peak of the dot-com boom. The 10-year treasury was at about 6.5%. By the end of that year, it had crashed and it had dropped to 5%. That's a massive move, and it would translate to much noticeable lower mortgage rates. So here's the irony. A stock market pullback, that could actually be good news for home buyers that are kind of waiting on the sidelines. Okay? So that's been a lot of stuff, guys. So let's bring it all together, because at the end of the day, you're probably here because you want to know, should I buy now? Should I wait? And what the hell are mortgage rates going to do? And I'm going to give you the most honest answer I can. Okay? So right now, mortgage rates are elevated. There's no sugarcoating that. The combination of high oil prices driving inflation, the Fed's short-term bond buying, adding money to the economy, and the stock market keeping investors in risk-on mode has been a perfect storm for keeping mortgage rates higher than most of us want. The three things that would need to happen for rates to come down right now in a meaningful way are, number one, yes, oil prices need to cool off. If we see oil drop below 80 to 85 a barrel and stay there, that takes real pressure off of inflation, and then bonds start to breathe again. Number two, the Fed needs to stop buying short-term treasury bills. If that new Fed chair comes in and ends that program, it removes one of the key sources of inflationary pressure that's been hurting mortgage bonds. And number three, the stock market needs to see a correction. When that happens, not if, when money rotates into bonds and mortgage rates follow. Now, none of us can tell you exactly when that, when those things will happen. We don't have a crystal ball. It could be soon, it could be next year. The market moves on its own timeline, okay? We're all hoping we see those things quickly. So what you should actually do now if you are trying to buy a home right now, let me give you some practical takeaways that you can use. First of all, don't try to time the market perfectly. I know it's tempting to wait for rates to drop before you buy. And yes, they may come down, but here's the reality, guys. All right, if rates drop from, say, 7% to 6%, prices may rise for some buyers because buyers are going to flood into the market. All right, so focus on your payment, not the rate. Run the numbers on what a home actually costs you per month at today's rates. And if that payment fits your life and your budget, that's what matters most. Rates may come down in the future, and if they do, you can refinance. But guess what? You can't go back and buy a home at today's prices if you wait and they rise. And third, lock in when it makes sense for you. If you're under contract on a home and rates tick down even slightly, like mortgage bonds recovering as they are today, talk to your lender about whether it's time to lock your rate. Fourth, watch the economic headlines, the NVIDIA earnings, the oil prices, Fed's commentary. Those all can move mortgage rates in a matter of hours. So stay informed. And fifth, work with a mortgage professional who actually tracks this stuff daily, not someone who just quotes you a rate and disappears. You want someone who can call you and say, hey, Joe, guess what? Rates just improved this morning. Let's have a conversation. That's the kind of service that you can actually save money on, okay? So guys, that's it. This is your weekly market update. Here's the bottom line. Markets are complicated right now. Oil is high, bonds are under pressure, and the freaking stock market is running hot in a very narrow lane, and the Fed is doing things that aren't particularly helpful for long-term rates. But there are reasons for cautious optimism. So things do change, and they will for home buyers who are prepared, okay? So if this video helped you understand what's going on a little bit, do me a favor. Hit the like button, subscribe if you haven't already, and drop your questions in the comment. I read every single one, and I'm going to do my best to answer all of them. And as always, if you want to talk through your specific situation, you can always reach out to me via text at 815-735-7431. That's what I'm here for. I'll see you next week. Take care.